They told you the U.S. economy is strong, job numbers are rising, unemployment is low, and everything's back on track. But what if I told you the job boom everyone's celebrating is built on data that keeps vanishing? In the past few months alone, the government quietly erased over 250,000 jobs from official reports without a single headline. These weren't layoffs, they were revisions, silent corrections that rewrite the past long after the market has already reacted. You're being shown a recovery that may not exist, and the deeper you go, the more you'll question what's real. Why would a system inflate numbers it knows will collapse later? You're watching the market rally. Stocks climb, news anchors beam. The economy is back, they say. The U.S. just added over 140,000 jobs. It's in the headlines, on your feed, reinforced by analysts in tailored suits saying this changes everything. But 3 weeks later, while no one's watching, that same number is quietly corrected. Not by a little, by 90%. The official count drops from 140,000 to just 14,000. No press briefing, no breaking news, just a silent update buried on a government site behind 4 clicks and a PDF. Preliminary estimate subject to revision. But this wasn't a rounding error, and it wasn't the only one. In May and June of 2025, the Bureau of Labor Statistics reported a total of 280,000 new jobs. The following month, they erased 258,000 of them, not with fanfare, with silence. Imagine building an entire economic narrative on that data. Stimulus decisions, investment flows, public optimism, and then learning it was vapor, a fiction corrected after it already shaped reality. This isn't a bug in the system. It is the system. The BLS calls it methodology, adjustments made when late responses arrive, when seasonal models are rebalanced, when algorithms detect anomalies. But none of that matters to the traders who bought based on the first release, or to the families who believed the recovery was real, because by the time the truth catches up, the damage, or the illusion, is done. There's a term for this, the first release premium. It means the initial number has the most power, the most influence, because it moves markets before it's even confirmed. It's like reporting a fire, then whispering later that it was just smoke, except the building's already evacuated and insurance claims have been filed. The correction becomes an afterthought, a technicality, and it keeps happening, month after month, year after year. These revisions are rarely front page, yet they quietly rewrite the story of the American labor force, one invisible edit at a time. And here's the part that makes it dangerous. Most people never see the revision. They remember the boom, not the erasure. So what does that create? A public that believes things are better than they are. A market that's primed to rise on good news, never fully reckoning with the bad. A political environment where leaders can point to progress and hope no one checks the footnotes. This isn't just statistical noise, it's about narrative control. Because if the illusion of job growth is maintained just long enough to sway sentiment, pass a bill, or hold an election, the correction becomes irrelevant. The lie served its purpose. And maybe it's not a lie. Maybe it's just timing. But the result is the same. Perception moves faster than truth. And in that delay, power operates unchecked. If you've made it this far, you already feel it. Something's off. This isn't just data being updated. It's a pattern, one that rewards those who move early and blinds those who wait. If you're the kind of person who questions headlines, who looks past the surface, you're in the right place. Like this video, subscribe to the channel, and follow us deeper. Because next, we'll show you exactly how the illusion is sustained, who keeps it quiet, and why silence may be the most profitable asset in the American economy. The strange part isn't that the numbers change, it's how quietly it happens. No alarms, no primetime segment, just a revision, buried in bureaucratic rhythm. Every month, like clockwork, the system cleans itself, and no one speaks. You'd think that erasing 250,000 jobs would trigger outrage, questions, audits, but it doesn't, because most people never even notice. That's not an accident, that's the engine. Behind every jobs report is a machinery of silence, institutional, procedural, almost surgical. The Bureau of Labor Statistics doesn't need to hide anything. They just need to publish it where no one looks. Deep in release notes, inside footnotes, in spreadsheets with headers like Table B1, Establishment Data Seasonally Adjusted, Cold, Impersonal, Perfect Camouflage. Journalists? They move fast. They write headlines within minutes of the initial release. By the time revisions arrive, the news cycle is moved on. The corrections are late, quiet, and almost never go viral. Politicians? They quote the first number, always the first. If it helps their case, they amplify it. If it gets revised down, they don't go back and clarify. Why would they? By then, the camera's off. Even economists, the ones who know better, treat revisions as a technicality, expected, acceptable, a statistical footnote in the grand narrative of economic recovery. But when acceptable means consistently overstated progress, when the illusion persists long enough to shape perception, it's no longer a footnote, it's a feature. And who benefits? The market does. Traders and funds learn the pattern. They know the game. They bet on the first number, ride the wave of optimism, then exit before the revision lands. It's not fraud, it's just anticipation. But it creates a split reality, one for those who move on signal and another for those who believe the story. The silence isn't just absence of noise, it's strategy. The system isn't built to deceive, it's built to remain unchallenged. Complexity is the first shield, delay is the second, and apathy, that's the final layer. By the time the correction is visible, the world has already accepted the fiction. And here's where it gets darker. Every adjustment resets the scoreboard. It makes past optimism untouchable. It says, that was true at the time. But what does that even mean? Truth that expires? Confidence that dissolves under revision? There's a reason the BLS rarely makes revisions upward during downturns. Optimism sells, fear destabilizes, and so the default setting is growth until proven otherwise. This cycle isn't accidental, it's protected, not by conspiracy, but by design. A system where technical transparency and practical invisibility coexist. The data is public, but the truth? That takes effort. It requires you to follow the trail, even when it leads underground. And that trail doesn't stop at jobs reports. Because if illusions can be engineered monthly, quietly, with no consequences, what happens when the same logic is applied to bigger numbers? Next, we uncover how these silent revisions ripple into forecasts, policy decisions, and even global trust in the American economy. When perception becomes currency, who's really printing the money? When job numbers are inflated, it's not just public confidence that rises. Forecast models shift, algorithms adjust, interest rate expectations realign, and suddenly, the entire architecture of economic policy starts reacting to something that was never real. Think about how decisions are made at the highest levels. The Federal Reserve doesn't just look at raw numbers, it looks at momentum, direction, signals. And when the signal says job growth is strong, the Fed prepares to tighten, raise rates, slow down the economy to prevent it from overheating. But what if that overheating was just a mirage? In July, projections were recalibrated based on those original job reports. Economists raised GDP forecasts. Investors braced for further rate hikes. The bond market retracted. Every move, every reaction based on data that, weeks later, would be erased by revisions. But those revisions don't undo the decisions. They don't rewind the rate hike, or reverse the stock trades, or restore the confidence lost in a dip that wasn't supposed to happen. It's like navigating with a map that changes after you've already turned. You don't just get lost, you think you're on track until you're not. And by the time you realize, the cost of that detour is irreversible. This isn't hypothetical. In 2023, a wave of strong job reports led the Fed to commit to aggressive tightening. By the end of Q4, those numbers were revised sharply downward, but the damage was done. Credit markets had already frozen. Small businesses had already downsized. Entire sectors were priced for strength that never existed. This is how perception compounds, not just among investors, but within the very institutions that set the rules of the game. Forecasts are supposed to guide, but if the data feeding them is unstable, or worse, biased toward optimism, then every projection becomes a kind of fiction, a well-modeled hallucination. And here's the twist. Those responsible for these forecasts often know how fragile their inputs are. The footnotes are clear, the revisions are expected, but the machine must keep running. Every central banker, every institutional investor, every macro analyst is forced to play along, adjusting, hedging, pretending the number matters because the market believes it does, until it doesn't. This disconnect creates what some economists call statistical volatility. But that's just a clinical term for a much deeper fragility, one where policy is based not on truth, but on timing, where decisions are made too soon and accountability comes too late. And when the story of recovery is built on a mirage, what happens when that mirage collapses? That's what we'll explore next, because in the final chapter, we'll reveal the hidden architecture behind these illusions and the quiet players who've mastered the art of profiting from perception itself. When the truth moves slower than the market, who always stays ahead?
There are people who don't wait for the truth. They trade the illusion. They don't care if the jobs report gets revised next month because their positions are gone in hours, sometimes minutes. They're not reading the data, they're reading the reaction. These are the perception brokers. Quiet, fast, deeply informed. Hedge funds, algorithmic traders, market makers who've learned how to monetize narrative lag. They don't need certainty, just a head start. When the Bureau of Labor Statistics releases its initial figures, the race begins. Algorithms scrape the report in milliseconds, placing trades before most humans even finish reading the headline. If the number looks strong, buy equities. If it disappoints, shift to bonds. It's a game of speed, not accuracy. But here's the secret. They know the number is soft. They know it'll be revised. They know the system favors optimism early, then adjusts downward later. And that's not a bug. It's a feature they've learned to exploit. Every revision is just confirmation of a trade already made. They made money on the boom, then disappear before the correction hits. And while the public is digesting yesterday's reality, they're already trading tomorrow's illusion. This asymmetry isn't illegal. It's not even hidden. But it creates a market where those with speed, tools, and institutional access can profit from belief itself. Belief in a recovery that may not exist, in numbers that won't hold, in headlines that vanish. And while the brokers extract billions in silent trades, the rest of the economy moves on false signals. Small investors hold the bag. Policymakers chase shadows. The public trusts a version of reality that's been rewritten in the margins. The brokers don't need to lie. They just need to be first. And when perception becomes a commodity, something to be bought, sold, and arbitraged, truth becomes irrelevant. What matters is the moment between report and revision. That's where the profit is. That's where the game is won. And maybe that's why the illusion persists, because too many people benefit from the delay, from the silence, from the belief that the system is stable, the numbers are honest, and the story is real. But now you've seen behind the curtain. You've followed the trail, from the disappearing data to the silent machinery that erases it, to the forecasts built on shadows, and finally, to those who shape the market through perception alone. They're not manipulating the data. They're not rewriting the economy. They're simply playing a game where timing beats truth. And in that game, most people never even know they've lost. The most dangerous lies are the ones no one needs to tell out loud. A chart trending up, a press release glowing with optimism, a number that feels real until it quietly disappears. No alarms, no scandal, just silence. Because when you control the first version of reality, you don't need to correct the past. You already shaped the future. This is how the illusion survives, not through force, but through timing. And in a world where speed is power, the truth always arrives late. If you're done waiting for the truth to catch up, like this video, subscribe to Bull Secrets, because here, we don't chase headlines. We expose what was never supposed to be seen.